What's going on, traders? Welcome to today's video, and we're going to get right into this. I'm going to cover how gold is impacted by interest rates. I'm going to talk about my three-step analysis process when going to trade something like an interest rate decision. We're going to talk about market expectations. This is very important so that way we know how to actually trade when the decision comes out. And also, there's something being released called Fed's projections. We're going to cover what that is, how we can trade it. I'm going to talk about the three possible outcomes that we can get from this rate decision. And also I want to cover what I believe the best tradable opportunity would be going into this rate decision. So that being said, let's get right into it. Once again, this is what we're going to be covering for this video. And let's talk real quick on how is gold impacted by interest rates. To keep this as simple as possible, just understand that higher interest rates, you would be looking for gold sells, right? Higher interest rates is bearish or bad, if you will, for gold sells. I don't like saying bad or good. We can profit in either direction, but higher rates, gold sells. Now, the inverse is true. If we're looking at lower interest rates, you're looking for gold buys. This is one of the ways that interest rates can help you determine your bias on when to trade gold. Also, side note, it'll help you avoid fake outs, but that's a whole different story. Now, let's go into the next piece, right? Once again, very simple, gold, inverse correlation with interest rates. Next, I want to talk about my three-step analysis process. We can move this off for here, and I'm going to talk about this. So this is, for me, how I look at not only interest rates, but also how I look at just economic data in general. Number one is expectations. Your best tradable opportunity comes when you have a surprise or a shift in market expectations. So what that means is, like, if we have the markets expecting a rate cut, and then we don't get the rate cut, that's considered a surprise. You don't know that it's a surprise if you don't first know the expectations, which is why in anything, you have to know what the expectations are, or at least in my opinion, I don't like to say you have to, I recommend that you know the expectations. Otherwise, how do you know if it's a surprise scenario? And then the third piece, right? The bigger picture. What this means is, does this data change the bigger picture? And this is how you can understand if a trade is going to be a scalp or if it's going to be a swing trade. Swing trades and scalps, believe it or not, but mainly swing trades, it comes from fundamentals. Like if you're trading gold, a swing trade is going to come from something making gold move higher or lower for a longer period of time. If you want to pause the video and go look, March 2022, when the Feds first started raising rates, gold was bearish for an entire year, right? We were bearish on that. Now, this is where we get our swing trades. I can show you a bunch of examples of that, but we won't go too deep into it. The next thing I want to talk about, let's get right into market expectations. Okay, so we're going to go into the Fed's dot plot first, and I want to explain to you what this is. Now, you can read this with me, you can read this ahead of me, whatever you feel like. The Fed's dot plot is just a chart. It records each Fed official's projection for the central bank's key short-term interest rate. Now, I'm going to show you what this looks like, so don't let these words get confusing. It's just telling us what every Federal Reserve official has their own idea on when they believe interest rates is going to, or where they believe interest rates is going to be at a specific time, right? So if you were to ask me, hey, Josh, quarter one, quarter two, quarter three, quarter four, all for 2025, where do you think we're going to end in terms of interest rates? And then 2026, where do you think we're going to end? The reason this is important, well, before I get to that, it's updated every 3 months, fun fact, and it's released at the Fed's rate decision every 3 months. Now, I kind of explained this. It's meant to provide insight into the Fed's future rate decisions. The reason this is important is because it tells me, or the markets, what the Federal Reserve is expecting to do next year in terms of interest rates, because the markets are forward-looking. You can see here, I said it, this helps the markets look ahead because they like to price in what they believe the Fed will do in the future. Have you ever heard the term, buy the rumor, sell the news? Whenever you get a rumor in the markets, usually the markets move before the event that the rumor was about actually happens. It happens all the time, right? And especially with interest rates, it happens all the time. So this is important to be paying attention to, especially when the dot plot's being released, which is going to be released for December 2024 at this rate decision. So you can see what it actually looks like. And don't get overwhelmed, don't get confused, don't worry, we're going to break this down a little bit. It's just a bunch of dots, right? If we zoom in on this, you can see this is their projections, right? You have all the voters here, and if we look at the bottom, you can see 2024. So this is the one they released in September. This is basically telling us where they believe interest rates are going to be by the 12 months from the release of this report. So what does that mean? This was released Q3 2024. So these voters all here are expecting this is where they think rates are going to be by Q3 2025. Does that make sense? It's a 12-month projection from the time it was released. So once again, don't get too caught up in worrying about each individual number. They average these numbers out when it comes to this. But you can see here, these are the voters. You can see these are the numbers for interest rates, where they're expecting it to be. And then here, we can see the years, right? So just so you can get a visual of what that looks like, I'll move this off the screen for now. This is what's going to be released with the rate decision. Now let's talk about expectations. We now understand how interest rates are impacted by gold. We now understand what the dot plot is, or at least we have a general understanding of it. And now we can go into expectations and what are the markets currently expecting for the rate decision. We're currently sitting at 4.5 to 4.75 for interest rates. It's a range. If you ever look at maybe I can show you my news terminal real quick. If you ever look at their interest rates, see here how it says a target rate. It's not a specific number. It's a range. They call it the Fed's fund target or the Fed's fund rate, but it's a target range. So that's why you get this range here. We're currently sitting 4.5 to 4.75. Now they're currently expecting 4.25 to 4.5. This is a 0.25% cut. Also called, just in case if I say it throughout this video, also called a 25 basis point cut, right? So 0.25% is the market expectations. Now in terms of projections, like I said before, this is projections posted from the quarter. So from fourth quarter. Currently 4.4%. That's what they're expecting. And that's this. That matches with this, right? 4.25 to 4.5. It's like 4.35, 4.4%. Well, 4.375% to be exact. I don't want to throw a bunch of numbers at you to make this confusing. I just want you to see what these numbers are, because this is going to be important when that data is released. Now, first year, you can see the expectations, 3.4%. So what does that mean? That means by the end, Q4, 2025, they're expecting 100 basis points worth of rate cuts, so 1.0%. You see that? We're currently at 4.4 and then 3.4. So that means in the next 12 months, we'll be down 1% in interest rates. This is market expectations. This isn't gospel, right? This isn't going to be guaranteed. This is what the markets are expecting. Second year, 2.9%. So if you look at that, 0.5% in the following year. That's 2026. This can change. Data will change. Events will happen. But this is just forward projections. Then you can see year 3. And then the longer term, they're just looking at it hold. The Feds are expecting to hold at around 3% interest rates. Okay? So that's market expectations. Before we can get into what I want to see for tradable opportunities, there's 2 words that I need you to understand. And we're going to cover some quick terminology. Number 1, I want you to understand the word hawkish, right? So this refers to a stance or policy that favors higher interest rates. Higher interest rates control inflation and slow down an overheating economy, right? So I hope that's not too wordy. Basically, the word hawkish is more strict on inflation, even if it means slowing economic growth by raising borrowing costs, which, for those who don't know, borrowing costs is interest rates, right? So basically, if somebody, a central bank speaker, a politician, usually it's central banks, if they're hawkish, that means they're leaning towards fighting inflation and wanting to raise interest rates, right? So that's important to know, because if I can come out and say, remember what I said in the beginning? Higher interest rates is bad for gold. So if I just come out and say, hey, Jerome Powell, who's the chair of the Federal Reserve, hey, he just made a hawkish comment, I'm looking for gold sells. You see how that makes sense? Because now you know what hawkish means in terms of interest rates and monetary policy, and you know how monetary policy or interest rates impacts gold. So a hawkish comment, I'm looking for gold sells, right? Once again, it's not that simple, but that's generally how it works. Dovish is the next word. If we take a look at this one here, it's kind of the opposite. It refers to a stance or policy that favors lower interest rates, and now lower interest rates actually stimulate economic growth and increase spending. Dovish central bankers or dovish monetary policy is typically more relaxed on inflation in order to encourage growth. When you have lower interest rates, even when you have monetary stimulus, like if you look at the money printing, right, that's a dovish monetary policy. It increases the demand in the markets, it increases consumer spending, but when you increase consumer spending, you also increase inflation, right? When the demand for goods goes up, the price for goods goes up. So, long story short, understand these two terms because we're going to be talking about this at the next little cheat sheet that I have. And let's finish it off with this one right here. This is what I'm going to be looking at. Now, don't worry about all the words and numbers here. I'm going to break this down as simple as possible, starting off with the top here. So the Fed's rate decision, also called FOMC, it's being released Thursday. Now, this is military time. It's just easier. 1400 or 2 p.m. Eastern time. I'm sure it'll be a different time zone for you, but that's when it's coming out. Now, in order to look for possible hawkish outcomes, these are the things, I want you to look at this as kind of like a checklist. These are the things that I'm looking for in order to take these trades. Now, I'm focusing this more on gold right now. I probably should have just deleted the other ones, but you can trade US dollar equities on this as well. Now, if we see a pause or no rate cut at all, this, in my opinion, would be considered hawkish. Now, the thing is, I would consider this to be short-term hawkish because if they're pausing rates, it's still technically dovish, right? They're not raising rates, they're just pausing. They're not doing anything. Now, the reason I would look at that to be short-term hawkish is because of this. If we take a look here, hopefully this is big enough for you guys to see. The Federal Reserve, this is for my news terminal for everyone who's going to ask, the markets are currently, you can see here, almost 97% priced in for a negative 0.25 cut, right? So you can see here we're only 3% priced in for a pause. This is important because, like I said before, that would be considered a surprise. We're almost 100% priced in for a pause. We're almost 100% priced in for a rate cut. So if we don't get the rate cut, then that would be one reason, specifically for gold, I would be looking for sells right off the bat. If we get a pause, I'm taking gold sells. Obviously, I want price action in my favor, but I'm taking those sells. Now, the reason it would be short-term and I would still long-term look for gold buys is because a pause is still bullish for gold. It's still technically dovish, right? So now, another thing to look for possible hawkish outcomes would be the dot plot shows less than 1% of rate cuts for 2025. This is why I said this is important to understand this, right? So if you look here, 2025, we're expecting 100 basis points or 1.0% of rate cuts. So if they release their projections and it shows less than that, like it'll look like this. Let me show you my calendar. So this is what my economic calendar looks like, right? Once again, for my news terminal. And you can see here, we can see right here all the projections. Now, you're not going to see less than 100 basis points. You're going to see, instead of it saying, like right here it says 3.4, in the actual, you're going to see like 3.75, something higher. That means less rate cuts. Does that make sense? So if the markets now say, oh man, they're not going to cut as much as we were expecting, that's considered hawkish, at least short term, because once again, they're still cutting, just not as much. So those are both kind of short term. Now, another one for this little checklist here for hawkish outcomes would be a rate hike. This is extremely unlikely. I don't even think this is, I can almost guarantee you this isn't going to happen, but I'm putting it here just so that way I can cover all of my bases because, yes, a rate hike would definitely be hawkish. We would definitely be looking for gold sells if they hiked rates, just like we did all of 2022 when they were hiking rates, right? So that's what I'd be looking for a hawkish outcome. Now, if we go to the middle here and we talk about meeting expectations, this is one of the trickier pieces to trade. The reason being is if we get the rate cut, which we're already priced in for, you almost get volume with consolidation. And that's one of the most dangerous things to be trading. Some people want to call it choppy markets, call it mixed markets, whatever. So in my opinion, this is what I'll be doing. If we get market expectations and we meet market expectations, meaning we get the 25 basis point rate cut, there is a press conference. If you take a look here, I'll show you my calendar again. And we go to Wednesday, right here, Federal Reserve Chair Jerome Powell holds a news conference. Now, journalists, they get to do Q&A, they get to ask about monetary policy, they get to ask about the projections, they get to do all of that stuff, right? If we get the meeting expectations, gold's going to spike down because we're already priced in for it, and then people are going to try taking sells even though they cut rates, and gold's going to come right back up, and then it's going to consolidate, and you're stuck in drawdown. So just be careful for stuff like this. I'm going to wait for the press conference. That's what I want to see if we get the meeting expectation, right? Now, like I said, the best tradable opportunity is a surprise in the market. If we get meeting expectations, it's not a surprise. Now, in terms of a dovish outcome, remember the word dovish. If we get a 50 basis point rate cut, meaning the markets are expecting the 25, we get a 0.25 above what the markets are expecting. That's number one, that would be considered dovish. Number two, it would be the dot plot, right? If we can see over 100 basis points of rates cuts, once again, what that would look like is this. Instead of seeing a 3.4, you would see like a 3.0 or a 3.2. That would mean like 125 basis points or 150 basis points of rate cuts. That would be dovish or considered dovish because that's a change in market expectations. That makes sense? So those are really the three. I think the best scenario, the easiest one would be if they paused. Because we're already priced in for a cut, if they paused, we would get some pretty volatile moves and some pretty nice gold downside, at least for the short term. I don't think that's going to happen, though. The Feds really don't like surprising the markets. This is what I'm going to be looking for in terms of when the data is released by understanding the expectations and how I want to trade it. In terms of technicals, I can't really do technical analysis for you guys now. It's a little difficult because depending on when you're watching this, gold might be in a completely different place. It is literally just a matter of being able to mark up your zones, your support and resistance areas. Let's say we're sitting here right now. I can see these zones clear as day, if I was to mark that off. If we get a bigger rate cut, the 50 basis point rate cut, I'm taking buys on gold. I'm not waiting for this candle closure. If I see gold pushing up and I get the 50 basis point, meaning the data is in favor of gold buys, I'm entering impulsively, right? Is it risky? Sure. But I would actually say it's less risky because you understand the data and you understand everything that I just talked about. This is how you can avoid fake outs because let's say they did a 50 basis point rate cut, right? If I show you this again, let me bring up the cheat sheet one more time. If they do this one down here, right, a 0.5% rate cut, and you can see to here, I'd be looking for gold buys. But if they do a 0.5% rate cut and gold does this, I'm going to take a step back. Most people, if you're just trading technicals and you don't understand interest rates or how it impacts this stuff, they're going to take sells because they're just like, oh man, volume, I'm going to take it. This is how you avoid fake outs. If anything, that drop, I'm just going to wait for it to hit support, see if it settles, and then I'm taking buys down here because I understand that a bigger rate cut is bullish for gold, 100% bullish for gold. So if it drops or it goes against what I'd expect, this is when I take a step back and like, you know what, I'm going to sit it out. Now, sometimes that means I miss a trade. Most times, that's how I avoid fake outs. So mark up your zones, follow this analysis, and then take that to the charts. And that's it. I will be trading this live with my private trading community, so if you want to join us, I'll put the link in the description below. If not, I'll see you guys in the next video. Safe trading.